On a humid Tuesday morning in a glass tower overlooking downtown Chicago, a room of quantitative analysts pushed a single line of updated code into an automated risk algorithm. There were no press conferences, no public warnings were issued to the governor, no warning sirens sounded over the Pacific coast. But with that single keystroke, the financial foundation beneath $3 trillion of California real estate silently disintegrated. Within 48 hours, hundreds of thousands of homeowners across the Golden State opened their mailboxes to find identical, coldly worded notices from companies like State Farm, Allstate, and Farmers. Their property insurance was cancelled, not raised, not adjusted, but completely terminated. Among them was an ultra-exclusive enclave of tech billionaires and real estate tycoons who had spent millions building pristine estates, complete with private fire-retardant systems, cleared brush perimeters, and round-the-clock security details. They believed their immense wealth bought them absolute immunity from the forces of nature. They were wrong. Today, almost every traditional policy in that single zip code has been aggressively revoked, transforming some of the most expensive zip codes on planet Earth into massive, uninsurable financial traps overnight. This is not just another story about climate change, nor is it simply a streak of bad weather. What is happening right now in California is a quiet, ruthless structural collapse of the modern suburban dream. For nearly a century, American wealth accumulation has relied on a basic, unwritten promise. If you buy a home, work hard, and pay your mortgage, the financial system will back you up. Your house is your fortress, your primary investment, and your family legacy. But that promise was quietly anchored to a hidden pillar that almost nobody ever thinks about until it disappears: the willingness of private corporate entities to absorb catastrophic risk. When that pillar cracks, the domino effect is instant and brutal. Without homeowner insurance, you cannot maintain a mortgage. Without a mortgage, the pool of potential buyers for a property shrinks from thousands of families to a tiny handful of cash investors looking for distressed bargains. Property values do not just trickle down, they tank off a cliff. Neighborhoods that were celebrated as suburban paradises just 5 years ago are suddenly exposed as geographic traps, where homeowners are held hostage, unable to sell without taking life-altering financial losses, and unable to stay without risking complete ruin from a single spark. Right now, major insurance giants are not just tweaking their margins in California, they are executing a strategic, systematic retreat. They have run the numbers, modeled the future, and quietly decided that entire regions of the state are fundamentally non-viable for the modern capitalist model of property protection. To replace themselves, they have left behind a state-backed emergency safety net that was never designed to bear the weight of an entire state's real estate market. It is an agency operating on borrowed time and borrowed capital, teetering on the edge of its own systemic meltdown. If you think this crisis is confined to a few isolated mountain towns or homes built directly into dense pine forests, you are drastically underestimating the scope of what is unfolding. The line between a safe suburban street and an uninsurable red zone has been completely redrawn by corporate actuaries sitting thousands of miles away. It cuts through master plan developments, historic foothill neighborhoods, and pristine coastal valleys. Over the course of this investigation, we are going to trace the exact fault lines of this financial catastrophe. We will map out the 10 worst Californian suburbs where securing a basic homeowner policy has become virtually impossible, exposing how hyper-capitalist risk models, legislative deadlocks, and geographic realities have collided to create the ultimate housing trap. And deep within our journey lies the mystery of that hyper-wealthy enclave, a community that spent tens of millions of dollars attempting to outsmart nature and outnegotiate Wall Street, only to stumble into the single most devastating insurance collapse in modern state history. The rules of homeownership have changed forever, and the map of American real estate will never look the same again. The financial trap now locking down California suburban real estate was not built overnight. Its blueprint was drawn in November 1988, when California voters narrowly approved Proposition 103. Designed as a populistic revolt against skyrocketing insurance premiums, the ballot measure established a strict prior approval system for all property and casualty coverage rates. Under Proposition 103, insurance companies were legally forbidden from increasing home insurance prices without explicit, lengthy clearance from the elected California Insurance Commissioner. Furthermore, the law empowered third-party consumer advocacy groups to intervene in rate-setting proceedings, forcing insurance executives into public hearings that could delay necessary rate adjustments by months or even years. Casualty Actuarial Society. For nearly 3 decades, Proposition 103 was celebrated as an unquestioned victory for the consumer. It kept California homeowners' insurance rates artificially suppressed, well below national inflation averages. While states like Florida and Louisiana saw premiums adjust dynamically to tropical storms, California home protection remained remarkably cheap. But embedded within this consumer protection framework were 2 critical actuarial blind spots that acted as financial time bombs. First, Proposition 103 explicitly prohibited insurance companies from using forward-looking catastrophe modeling to set prices. Instead, state law mandated that insurers look backward, calculating future risk based exclusively on the average historical loss data of the preceding 20 years. Second, the state refused to let private insurance companies pass the skyrocketing costs of global reinsurance, the secondary insurance that carriers buy to protect themselves against mass insolvency, onto California policyholders. Personal Insurance Federation of California. As long as California's climate remained relatively predictable, this artificial suppression of risk held. But the underlying geographic and climatic realities were shifting beneath the state's feet. Between 2017 and 2021, a sequence of catastrophic wildfire seasons tore through the state, obliterating historical data models. The 2017 Tubbs fire wiped out entire suburban neighborhoods in Santa Rosa. The 2018 Camp Fire completely erased the town of Paradise, killing 85 people and causing over $16 billion in economic damage. In just 2 short years, private insurance carriers wiped out all the profit they had accumulated in California over the previous quarter-century. The historical 20-year average, required by state law to price policies, was rendered completely useless overnight. The corporate response was swift, mathematical, and uncompromising. As global reinsurance firms raised their rates by up to 40% to cover California liabilities, primary carriers requested corresponding rate hikes from the Department of Insurance. But the state regulatory mechanism moved at a bureaucratic crawl. In 2022 and 2023, while inflation pushed building repair costs and labor expenses up by over 30%, major rate increase applications languished in state review for upwards of 300 days. Confronted with a legally enforced business model that forced them to write policies at guaranteed financial losses, corporate boardrooms made the only rational decision left under free market capitalism. They stopped writing business altogether. In May 2023, State Farm, California's largest property insurer, with over 20% of the residential market, formally announced it would cease accepting new applications for commercial and personal property policies statewide. Less than a month later, Allstate followed suit, quietly revealing it had already halted new home insurance policies months earlier. By mid-2024, 7 of the top 10 insurance providers operating in California had either completely exited the market, limited new underwriting, or begun non-renewing tens of thousands of existing policyholders across high-risk zip codes. Property Insurance Coverage Law, blog. This corporate flight triggered an immediate migration toward the California FAIR Plan, the state's designated insurer of last resort. Established by the legislature in 1968 after the Watts riots, the FAIR Plan was originally intended to provide basic, temporary fire coverage for a small handful of urban properties that could not find standard insurance. It was never structured, capitalized, or staffed to serve as a primary insurer for millions of suburban homes. In 2019, the FAIR Plan held roughly 120,000 policies statewide. By late 2023, that number had exploded to over 350,000 policies, with billions of dollars in total exposure concentrated directly in the state's most fire-prone wildland-urban interfaces. The structural flaw of the FAIR Plan is that it is not a state-funded government agency. It is a syndicated risk pool operated by all private insurance companies licensed to do business in California. Every private company is legally forced to bear a percentage of the FAIR Plan's liabilities equal to their market share in the state. This created an inescapable trap for the state insurance commissioner and state legislators. If a major multi-billion-dollar wildfire hits a concentrated FAIR Plan zone today, and the FAIR Plan exhausts its cash reserves, state law mandates that private insurance companies must be assessed to pay for the remaining claims. This reality led to a paradoxical outcome. The more private insurers fled the standard market to avoid wildfire risk, the higher their exposure to the FAIR Plan's ballooning liabilities became. In an attempt to insulate themselves from total insolvency, carriers began systematically dropping policies in suburban zones adjacent to forests, canyons, and brush-covered ridges. What began in 1988 as a voter-backed initiative to keep housing costs low had transformed, 36 years later, into the primary catalyst for an unprecedented housing crisis. The state's strict price controls had inadvertently severed the connection between market price and actual physical risk, setting the stage for a catastrophic clash between state regulators, real estate markets, and private capital. The theoretical vulnerabilities of California's property insurance market erupted into an active financial and humanitarian emergency in January 2025, when the Palisades and Eaton fires ignited simultaneously in Southern California. Driven by 80-mile-per-hour Santa Ana winds, the blazes burned over 37,000 acres, destroyed more than 16,000 structures, and generated between $28 billion and $35 billion in insured loss. The Palisades fire alone became the single costliest wildfire in recorded United States history. Crucially, the disaster occurred not in remote timberlands during the heat of August, but in dense, high-value suburban coastal zones during the middle of winter. The event demolished the long-standing industry assumption that wildfire risk was seasonal and geographically isolated, triggering a cascade of secondary economic shocks across the state's housing sector. Latent insurance, еще два. In the immediate aftermath, the California FAIR Plan absorbed an estimated $4 billion in direct liabilities from the January 2025 fires. To cover the deficit, the FAIR Plan Board levied an unprecedented $1 billion special assessment against its private member insurance companies, the first such emergency drawdown since the 1994 Northridge earthquake. Under state regulations, primary carriers were allowed to pass only a fraction of this fee back to policyholders, directly eroding corporate capital reserves. In response, State Farm General filed for an emergency interim rate increase of 17% on homeowners' policies and 32% on rental dwellings, warning state regulators that without immediate rate relief and capital injections from its national parent company, its California subsidiary faced total rating downgrades and technical insolvency. Coverage cat, еще три. This escalation forced a direct confrontation between state regulatory authorities and corporate boardrooms. Insurance Commissioner Ricardo Lara attempted to stabilize the market through the executive rollout of the Sustainable Insurance Strategy. The regulatory framework represented the most fundamental overhaul of California property rules since 1988. Under the strategy, the state agreed to allow insurance companies to utilize forward-looking computer catastrophe models and pass the net cost of global reinsurance through to consumers in rate filings. In exchange, participating insurance carriers were legally required to write at least 85% of their statewide market share in designated wildfire-distressed zip codes, defined as areas where FAIR Plan policy concentration exceeded 15%, or where local fire risk scores reached critical thresholds. United policyholders, еще один. However, the implementation of the Sustainable Insurance Strategy exposed a severe operational deadlock. While regional carriers like Mercury Insurance and CSAA accepted rate approvals and committed to writing thousands of new policies, major national insurers stalled. Corporate actuaries argued that requiring carriers to expand coverage in high-risk zones, while global climate models predicted escalating storm and fire frequencies, created unacceptable systemic liability. Furthermore, Newly permitted catastrophe modeling algorithms generated risk scores that called for property premium increases of 100 to 300% in foothill communities, a price spike that state political leaders were deeply hesitant to pass on to voters ahead of election cycles. Latent insurance. As state regulators and private corporations locked horns, the real estate market became the primary casualty. Under federal guidelines set by Fannie Mae, Freddie Mac, and the Federal Housing Administration, every residential mortgage issued in the United States must be backed by a comprehensive hazard insurance policy. When traditional carriers issued non-renewal notices, real estate transactions across California came to an abrupt halt. Escrow closing timelines expanded from a standard 30 days to 60 days or longer, as prospective buyers struggled to secure insurance binders. In high-risk foothill zip codes, roughly 1 out of every 17 new residential mortgages was forced onto the FAIR Plan. Because the FAIR Plan provides only basic coverage against fire, smoke, and lightning, homeowners seeking standard mortgages were legally required to purchase supplementary policies, known in the industry as difference in conditions, or WRAP coverage, from private markets to cover liability, theft, and water damage. The combined cost of a FAIR Plan policy and a private WRAP policy routinely quadrupled annual home protection expenses, adding anywhere from $600 to $2,000 per month to standard residential housing costs. According to data from the Center for Environment, Energy and Land Use, average California homeowners' insurance premiums surged 84% between December 2020 and early 2026, while median policy deductibles jumped 40%. Stanford Woods Institute for the Environment, Stanford University. For high-value luxury enclaves, the traditional market vanished entirely, giving rise to an unregulated, shadowy secondary insurance sector. Wealthy property owners in locations like Calabasas, Rancho Santa Fe, and Ojai were pushed into the surplus line market, non-admitted insurance carriers, including offshore syndicates, that operate outside California Department of Insurance rate regulations. In these areas, annual premiums for custom-built estates rapidly climbed past $40,000 per year. Unlike admitted state carriers, surplus line policies carry no protection from the California Insurance Guarantee Association, meaning that if a surplus line carrier becomes insolvent during a major disaster, policyholders have no state recourse to recover their losses. By mid-2026, the California FAIR Plan's total residential financial exposure had expanded to over $603 billion, a staggering 424% increase since September 2020. Total enrollment climbed past 668,000 policies, representing 5% of all single-family homes in California. What was designed as a temporary emergency safety net for a tiny fraction of uninsurable structures had effectively transformed into the primary property insurer for the fifth-largest economy in the world. The state housing market had reached a profound impasse. Property values remained artificially inflated by historic low interest rates.